All right, today we are diving into something that, on the surface, makes absolutely no sense. We're talking about a company that just posted a multi-billion-dollar loss and then turned around and called it a success. How on earth is that possible? Well, let's get into it. So here's the headline number that's got everybody's head spinning. A $17.4 billion operating loss. In one quarter. For pretty much any other company out there, a number like that would be a complete catastrophe, right? A total death sentence. But for Strategy, it's apparently just part of the plan. So that's the big question, isn't it? How does a company lose that much money and not just survive, but actually celebrate it? That is the puzzle we are going to piece together today. And the answer, you'll see, is hidden inside a financial strategy that is, frankly, as audacious as it is kind of brilliant. Okay, first things first. We need to understand that this massive loss, it isn't what it looks like. This isn't because they launched a terrible product or had some kind of operational meltdown. Nope. The real story is actually hiding in a pretty simple but powerful accounting rule. And that rule is something called fair value accounting. Here's the deal. Strategy has to take its absolutely enormous pile of Bitcoin and value it at whatever the market price is at the end of every single quarter. So what happened? Well, Bitcoin's price took a dive right at the end of Q4. That forced them to report a $17.4 billion, and this is the keyword here, unrealized loss. They didn't sell anything, not a single Satoshi. This loss only exists on a spreadsheet. And this is where the story gets really, really interesting. Because while the accountants are over here, being forced to report these huge paper losses, the company's treasury, well, they're telling a completely different story, a much, much more optimistic one. And this slide right here really captures the central paradox of the whole thing. On one side of the ledger, you've got this massive paper loss. But on the other side, in that exact same year, they went out and bought another 225,000 Bitcoin. I mean, think about that. They are reporting these eye-watering losses while simultaneously and aggressively buying more of the very asset that's causing the paper loss. It's wild. And the scale of their bet here is it's just incredible. Strategy now holds over 713,000 Bitcoin. Let me put that into perspective for you. That's about 3.4% of all the Bitcoin that will ever exist. Ever. So the big question is, how in the world do you manage the insane volatility that comes with holding that much of one asset? Well, this is the clever part. They've come up with a really smart two-pronged plan. See, instead of just a one-size-fits-all approach, they've figured out how to create two totally different products from their Bitcoin holdings, and each one is designed for a completely different kind of investor. Okay, so prong number one. This is for the capital investor, the person looking for high growth who's totally comfortable with high risk. For them, there's the company's common stock, ticker MSTR. Think of this as their pure play vehicle for direct exposure to Bitcoin's price swings. And the company's CEO, Fang Le, he doesn't mince words about it. He calls MSTR a levered and amplified Bitcoin. So the goal here isn't just to track Bitcoin's performance. It's to use financial leverage to actually try and outperform it over the long haul. This is definitely the high-octane pedal-to-the-metal option. Okay, but what about the other side of the coin? What about investors who just want steady income and, can't stomach that kind of wild ride? Well, for them, Strategy created something totally different. A digital credit product they've nicknamed Stretch, which trades under the ticker STRC. Executive Chairman Michael Saylor really nails the appeal of Stretch here. He says it's a 10-second idea. And it really is that simple. It's an 11.25% dividend yield paid out every single month. That's it. It's designed for one thing and one thing only, stable income, not heart-stopping volatility. So let's just recap this, because it's pretty cool. You've got MSTR, the common stock, which is this high volatility play for capital growth. It's for the risk takers. And then you've got STRC, or Stretch, which is a low volatility product for fixed income, aimed squarely at the risk averse. They have literally engineered two financial products with completely opposite personalities, all from the exact same pile of Bitcoin. It's pretty genius. All right, so how does this whole machine actually work? How do they use one of these products to feed the other one? This is what the company calls building its digital fortress, and it's a fascinating process. It all works like a flywheel, really. Check this out. Step 1, they issue the stable, low volatility product, STRC, to those income investors. Step 2, they take all the cash they raised from that and use it to go out and buy more Bitcoin. And that leads to step 3, increasing the total amount of Bitcoin per share for the equity holders, which of course amplifies the value and the potential of the common stock MSTR. So the stable, boring product is literally funding the growth of the exciting, volatile one. It's a feedback loop. Now, to make sure this whole system doesn't just fall apart during a downturn, they've built this massive stability buffer. We're talking a $2.25 billion cash reserve. This pile of cash is enough to cover more than 2.5 years of their dividend and interest payments. That gives those credit investors a whole lot of confidence that they are going to get paid no matter what the market is doing. And you know what's really surprising is that despite this super aggressive strategy, their debt levels are actually pretty conservative. Their leverage is only around 13%. To put that in perspective, they're carrying less debt than the average tech company in the S&P 500, and way less than a sector like utilities, which is known for being heavily indebted. So what's the big picture here? What's the grand vision? Because this isn't just about one company's balance sheet, not at all. Strategy truly believes they are right at the very tip of the spear of a fundamental shift in the entire financial system. And their big bet is really on this growing wave of institutional adoption. I mean, look around. We're seeing political support from the very top. Big banks are starting to offer credit against Bitcoin. Your favorite fintech and brokerage apps are adding BTC trading. We've got almost 200 corporations holding it on their balance sheets now, and major crypto companies are even getting included in the S&P 500. This asset class is moving from the fringe to the mainstream at lightning speed. And this trend is not just happening, it's accelerating. I mean, just look at this timeline. Back in 2020, Strategy was basically one of the only big public companies doing this. By 2025, that number had absolutely exploded to almost 200 different corporations. Strategy isn't just riding this wave. In many ways, they helped create it. And this quote from Michael Saylor really brings it all home. He says, BTC is digital capital. STRC is digital credit. It takes an operating company to transform capital into credit. That's their whole vision in a nutshell. They want to take Bitcoin, this new, volatile form of digital capital, and transform it into a stable form of digital credit. And they're not aiming small. They're going after the massive $300 trillion global credit market. They see themselves as the company that builds the bridge between this brand new asset and the entire traditional financial world. So that brings us right back to where we started. That $17 billion loss, it wasn't a failure. It was just a predictable, even necessary feature of an incredibly audacious plan. By creating two totally different products for two very different investor appetites, one for the thrill seekers and one for the yield seekers, Strategy is trying to build a completely new kind of financial engine. And that leaves us with a big question. Are we watching the blueprint for a new kind of digital bank being built right before our eyes? Or is this just the single biggest, craziest bet in all of corporate history?